The YieldMax Mr. Option Income Strategy ETF, ticker symbol MSTY, has officially announced a 1-for-5 reverse split, effective before market open on December 8, 2025. This video is designed to be the definitive guide, a complete 8 minutes breakdown, on what this reverse split means, why it's happening, and how investors must prepare. We will explore what changes, what stays the same, and whether this signals strength or something more concerning. This video is for educational and entertainment purposes only. Nothing here is financial advice. Always do your own research or talk to a licensed financial professional before making investment decisions. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. What is MSTY? MSTY utilizes innovative financial instruments such as swaps and options to generate income, rather than simply tracking Mr. This approach enables investors to benefit from high payouts, though it comes with elevated volatility. Consequently, while MSTY offers exposure to the cryptocurrency market through MicroStrategy, its fluctuations will not mirror Bitcoin's movements, setting the stage for unique investment opportunities. MSTY's strategy capitalizes on MicroStrategy's substantial Bitcoin holdings, creating a distinctive profile in the ETF landscape. MSTY represents a unique approach to income generation linked to MicroStrategy, combining potential high returns with inherent risks, ultimately offering investors an innovative way to navigate the evolving cryptocurrency market landscape while understanding its individual dynamics and separate performance metrics. Understanding the 1-for-5 reverse split. A reverse split can seem counterintuitive at first, but it serves important functions for a company's stock. For example, in a forward split, a company divides its shares, multiplying the number of shares outstanding while reducing the price per share. In contrast, a reverse split consolidates shares, reducing the total number but increasing the price. This adjustment can help companies that need to maintain a minimum price to remain listed on stock exchanges, potentially smoothing out trading volatility and enhancing investor perception. The goal isn't to create wealth but to stabilize stock value. Let's clarify the mechanics of a 1-for-5 reverse split. By consolidating shares, companies seek to boost their stock's perception without actually altering their market capitalization. While a reverse split can help prevent delisting and improve trading conditions, investors must remember it does not address any fundamental issues affecting the company's performance. Why reverse splits happen? Reverse splits are often a response to trading issues stemming from low prices, which can pose liquidity risks. When share prices drop, options contracts can become underpinned by lower valuations, complicating trading strategies. A notorious example includes YieldMax ETFs, which frequently endure the ramifications of high volatility decay. MSTY, linked closely to Mr. faces unique pricing challenges fueled by this volatility, mirroring the struggles of past reverse split ETFs like TQQQ and SOXL. Through these historical instances, we see the cyclical nature of reverse splits and their impact on investor confidence, illustrating the ongoing challenges faced by funds operating under market pressures. Understanding this pattern can help investors navigate the complexities of volatile trading environments more adeptly. YieldMax's option income strategy ETFs employ a synthetic covered call strategy, using swaps instead of owning the underlying assets. This innovative approach generates income primarily from option premiums. However, investors should note that these ETFs are not designed for long-term net asset value growth, often resulting in high yield coupled with high decay. Hence, they function best as short-term yield supplements, offering immediate gains. Due to the unique structure and strategy of these ETFs, they frequently undergo reverse splits to maintain an optimal share price. This adjustment helps manage market perceptions and keeps the trading activity more stable, ensuring continued attractiveness for investors seeking yield in fluctuating markets. MSTY's performance and NAV analysis. MSTY's demonstrated significant fluctuations in its net asset value, NAV, over the past year, influenced heavily by the cyclical nature of Bitcoin prices. As Bitcoin experiences rapid rises and falls, MSTR's volatility closely follows, creating ripple effects in MSTY's pricing structure. Observing these patterns helps investors understand potential changes as they assess the longevity of YieldMax ETFs amidst market changes. Understanding the erosion patterns of MSTY's NAV reveals critical insights into the fund's performance, particularly when considering how it reacts to the broader cryptocurrency market dynamics. Premiums and discounts often display notable variations based on market sentiment and investor behavior, adding complexity to the analysis. A thorough analysis of MSTY's NAV alongside the influence of Bitcoin cycles and MSTR volatility reveals essential insights for investors navigating the complexities of the market, highlighting the importance of recognizing warning signs for potential reverse splits as market conditions evolve. After a reverse split, traders need to understand that the contracts themselves will reverse split as well. With this adjustment, the strike prices will multiply by 5. Meaning traders have to recalibrate their expectations for potential profits and losses in this newly adjusted marketplace. Contracts will now consist of 20 shares each until expiration. This adjustment also leads to a temporary decrease in liquidity in the options market, as market makers take their time to rebalance their positions following these modifications. Understanding these changes is crucial for traders looking to navigate this altered landscape effectively. Impact on dividends after the split. Understanding the impact of reverse splits is crucial for investors. While the yield remains proportional and overall income stays unchanged, the payout per share actually increases. This may seem beneficial, but it's essential to consider the broader implications. Reverse splits are sometimes a signal of declining performance and can lead to lower future yields, causing concern among shareholders and heightening market volatility. In light of this, investors must remain vigilant, as the potential for accelerated decay looms, further complicating financial forecasts. While reverse splits can momentarily enhance the per-share payout, they often signal deeper issues within the company. This added layer of risk necessitates a cautious approach, reminding investors to thoroughly assess their strategies in the face of potential volatility and uncertainty. In the world of finance, a reverse split can often be misinterpreted as a strong move. However, it typically signals underlying weaknesses in the asset's value. As the price is artificially inflated, investors may perceive this as a rescue maneuver rather than a sign of health. Yet, while it's crucial to recognize these warning signs, a reverse split doesn't inherently mean a stock is doomed to collapse. Instead, it could enhance trading performance or attract new investors back to the fold. Understanding these dynamics is vital for informed decision-making. Typically, investors must gaze beyond the immediate price changes. Navigating the complexities of reverse splits requires a nuanced understanding. While they often indicate distress, the potential for improved performance and renewed investor interest cannot be overlooked, emphasizing the importance of thorough risk analysis and financial decision-making. Is this good or bad for investors? In the world of investing, short-term traders focus on quick gains, often capitalizing on market fluctuations. They thrive on volatility, utilizing strategies that benefit from immediate price movements. In contrast, long-term holders prioritize the value of their investments over extended periods, banking on the gradual appreciation of their assets. For them, patience is key. They weather market storms, believing in the inherent strength of their chosen investments, which often provide dividends and other benefits that compound over time. Understanding these differences is vital for strategizing effectively. Ultimately, the strategies of traders and holders cater to different market conditions and objectives, highlighting the importance of aligning investment approaches with personal financial goals and risk tolerance for optimal outcomes. The December 8th reverse split does not instantly fix anything. But it does reset the price, help liquidity, and improve options pricing. The key question investors must ask themselves is simple. Am I using MSTY for short-term income, or am I expecting long-term growth? Final warning, MSTY is an income tool, not a growth vehicle. The reverse split is a reminder to treat it accordingly.